for today, and we'll first start off by talking about the deal.
So first up, I'll be talking about Pfizer. Currently, as of December 4th, 2020, Pfizer is the second largest pharmaceutical company. However, Pfizer wasn't always so large. Looking at it back from 1999, Pfizer was the fifth largest pharmaceutical company and the second fastest growing pharmaceutical company. It had its most profitable markets in the United States and Japan, with sales up to $27.2 billion. Pfizer specializes in vaccines, cancer, heart, and diabetes treatments, and also develops, manufactures, and sells healthcare products worldwide. Some of the products it's known for are Advil, Viagra, Xanax, and Zoloft. In addition, Pfizer makes medicines for disorders of the endocrine and nervous system. Next up, Jesse will talk about the Warner Lambert.
Thank you. So Warner Lambert is also a pharmaceutical company, and they were also the fastest growing pharmaceutical company back in 1999. Their largest geographic segments are in the United States, Ireland, and Germany, and their revenue consisted of $12.9 billion in December 31st, 1999. Lastly, the Warner Lambert manufactures and markets pharmaceutical, consumer healthcare, and confectionery products, including popular brands such as Listerine, antiseptic mouthwash, chocolates gum, Sirts mints, and Rolaids antacids. Moving on, I'll be talking about the deal rationale. Pfizer wanted to merge with Warner Lambert in order to block American Home Products and Warner Lambert from combining into largest pharmaceutical company. Secondly, to combine research and development operations of the company headed by Pfizer Vice Chairman Dr. John F. Nick Black, will have a worldwide scientific staff of over 12,000 and $4.7 billion in annual R&D expenditures in 2000, the largest in the industry. The combined companies have few research overlaps and a total of 138 compounds in development in areas including central nervous system disorders, oncology, cardiovascular disease, metabolic disease, and infectious disease. Next, there are also expected cost reduction synergies by eliminating organizational redundancies. A strong international presence with enhanced global reach in all major markets, including Japan, the second largest pharmaceutical markets in the world, where Pfizer is the leading non-Japanese pharmaceutical company. Lastly, a major presence in the consumer healthcare field by expanding into other pharmaceutical segments besides just the one that Pfizer focuses on. And next, I'll be talking about the timeline of the mergers. Since 1996, the two companies have co-promoted an anti-cholesterol drug called Lepter. And on November 3rd, 1999, Warner Lambert entered into a merger agreement with American Home Products. And the day after, American Home Products and Warner Lambert announced to the press their intention to merge, creating the world's largest pharmaceutical company, American Warner. And on the next day, Warner Lambert rejects $80 billion takeover bid from Pfizer. And on December 1999, Pfizer started a hostile takeover of Warner Lambert because Pfizer began to fear that it might lose its agreement on Lepter with Warner Lambert. Lastly, in February 2000, Pfizer announced it would acquire Warner Lambert in an all-stock deal the companies have valued at $90.2 billion. Next, I'll be passing it on to Danielle, and he will be talking about the results of the merger.
Here are some of the key results of the merger. One of the results that I want to highlight is that there was a $1.6 billion in cost savings in just about 3 years after the merger. One other significant key result is business and geographic diversification. As Jesse mentioned earlier, Pfizer and Warner Lambert had different product specialties, so the merger helped them diversify their product lines. In addition, Pfizer had a big market in Japan, while Warner Lambert was big in Germany and Ireland, so the merger expanded their geographic markets as well. Next up, Alex will be talking about the WACC calculations of the firm.
Awesome, thank you, Daniel. So we decided to use the weighted average cost of capital as our discount rate for valuing this merger. Our cost of equity and cost of debt were based on the assumptions shown in the slides. Our risk-free rate was the 10-year Treasury bond yield at the time, and market risk premium reflected the average stock minus bond market premium at the time. Equity beta and debt beta were based on the historical and financial analysis of Warner Lambert. So for equity beta, we decided to average out the equity betas for other pharmaceutical companies like in the same industry. That came out as you can see, to be the 0.82. And the debt beta was based on the AAA bond rating of Warner Lambert at the time. The average debt beta for AAA bond companies was 0.05. So let's move on. So using the cost of debt and equity numbers and an assumed effective tax rate of 29%, this yields a weighted average cost of capital of 5.83%. And that's what we use to determine our valuation. So let's move on. So I'll speak about the standalone valuation of Warner Lambert next. We then estimated the free cash flows based on a growth rate of 4.4%, which was the compounded annual growth rate of the pharmaceutical industry at the time. The assumption is that Warner Lambert will continue to grow at the same rate that the pharmaceutical industry does. Other assumptions such as CapEx over sales and net working capital over sales were calculated based on the historical rates. Move on to the next slide. And we then calculated enterprise value to be $55.3 billion based on these cash flows. Add in debt, subtract cash, and this gives us our equity value of $55.7 billion. We divide by shares outstanding, and this gives us the 64.24 price per share valuation. So this is pretty close to the actual pre-merger stock valuation of the time for Warner Lambert, which was trading at roughly $69 per share. So I'll pass it off to Tyler now, who will speak about the financial synergies.
Thank you. So based off the deal rationale, we took into account the 1.6 billion cost savings as the quantifiable synergy. Based on the stated cost savings, we recorded cost savings of 200 million in 2001, 800 million in 2002, and 600 million in 2003, summing up to 1.6 billion savings by the end of year 3. So next up, once we get the cash flows, we sum up the present value of the cash flows and the cost savings and found the enterprise value of 86,945. After subtracting debt and adding cash, we got an equity of 87,342. To find the price per shares, including synergies, we simply divided shares outstanding and got a price of 174, which is similar to the premium of $93.31 per share that Pfizer paid for Warner Lambert's shares. And so next up, we'll be talking about our sensitivity analysis. This is our sensitivity analysis that shows the stock price given different WACC rates and growth rates. As you can see, a small increase in WACC or growth rate results in substantial changes in the stock price. For example, a 3% growth paired with a WACC rate of 5.5% would result in a stock price of $47.84, while a 4% growth rate with the same WACC rate of 5.5% would result in a stock price of $82.81, thus indicating that it's a highly sensitive stock price. Next, Daniel and Valeria will talk about the deal structure and terms.
Now I'll be talking about the deal structure and terms. In this hostile merger deal, it was an all-stock deal, and the reason that they chose to do all-equity deal was to avoid taxes and acquire full control of the target company, Warner Lambert, including all the employees and management. In this deal, Pfizer exchanged 2.75 shares of its common stock for each outstanding share of Warner Lambert stock in a tax-free transaction valued at $98.31 per share, or $90 billion, based on Pfizer's closing price of $35.75 as of February 4th, 2000. And this is considered a forward merger, as Warner Lambert, which is considered a target company, ceased to exist after the merger. Next up, Valeria will give further explanation about deal structure.
Thank you, Daniel. So as Jesse said before, Pfizer acquired Warner Lambert in the year 2000. The deal ended the 3-month hostile battle to acquire Warner Lambert. This resulted in Warner Lambert stockholders owning 31% of the merged company, and Pfizer stockholders still owning the majority, which was 69%. This $90 billion merger resulted in the creation of the second largest pharmaceutical in the world. Pfizer acquisition of Warner Lambert resulted in the combined group having 8 products with greater than $1 billion in global sales and R&D budget, which amounted to $4.7 billion. The combination gave leadership position to Pfizer in the areas of cardiovascular, lipid control drugs, central nervous system, and infectious disease pharmaceutical segments. Additionally, the diluted EPS went down from 1.47 to 0.22 cents post-merger. The credit rating prior to the merger was at AAA level. Post-merger, Pfizer's credit rating stayed at AAA. Today, Pfizer's credit rating is an A2 level, which is less than in the year 2000. Now we will talk about the further analysis we conducted. Alex will help us with this.
Yep. So I'll talk a little bit about the stock market reaction to merger bids. So we use the market model approach to calculate the daily percent change of abnormal returns. So if you look at the blue line, on November 3rd, 1999, AHP announced a bid to merge with Warner Lambert, which is reflected in the positive 7% abnormal returns on the blue line. The hostility from this merger comes from Pfizer, actually, who then hastily outbid AHP on November 4th in an attempt to undercut AHP. So if you look, this led to another 8% positive abnormal returns for Warner Lambert, who received 2 good merge bids, but a negative abnormal return for Pfizer, who just paid a premium on the deal to outbid AHP. Let's move on to the next graph. The merger with Pfizer was announced on February 8th, 2000. So as you can see from the graph, this is how the market reacted to this news. However, one factor to note is that much of the market reaction was already priced in from the November bidding war. So I'll now pass on to Daniel, who will discuss the Warner Lambert's post-merger performance metrics.
Okay, so this graph shows the gross margin of Pfizer before and after the merger. We use gross margin as one of the analysis metrics because there was a $1.6 billion cost synergy due to the merger. Gross margin is calculated by subtracting cost of goods sold from revenue and dividing by the revenue. In the graph, the pre-merger values are shown in the blue line, and the post-merger values are shown in an orange line. As illustrated in the graph, the gross margin increased after the merger from 81% in 1997 to 88% in 2002. This means that their cost of goods sold value decreased after the merger, indicating that the business is now operating more efficiently at a lower cost. Next up, Tyler will be talking about SG&A and R&D values to sales, comparing it to pre and post-merger.
Okay, thank you, Daniel. So in this graph of SG&A expenditures pre and post-merger, you can see the actual post-merger SG&A expenses are lower than forecasted pro forma expenses. Further analysis actually revealed that the post-merger SG&A was close to the estimates of cost savings that Pfizer had anticipated. In February 2001, there was an anticipated 200 million reduction in SG&A, 800 million in 2002, and 600 million in year 2003. Although it's not exact, we can see the changes in the forecasted cost synergies trend line, which shows the cumulative savings relative to the pro forma trend line. So next up, in this SG&A to expense to sales graph, you can see Warner Lambert had a higher SG&A to sales ratio than Pfizer. Post-merger, however, we can see the actual SG&A to sales ratio lowers dramatically. This illustrates that Pfizer was able to streamline the addition of Warner Lambert's costs with its own and dramatically increase their sales relative to their SG&A expenses. Thus, we can see the cost reduction synergies had a large impact on SG&A relative to their sales. And so next up, as you can see in this graph showing pre and post-merger R&D to sales, the post-synergies R&D to sales seems to be in line with the forecasted R&D to sales ratio up until 2003. From 2003 and onward, we can see the actual R&D expenses to sales ratio going below the forecasted pro forma R&D sales. This can be explained by the fact that typical pharmaceutical R&D projects like the creation of drugs can take years. And that's why we see the R&D to sales ratio dip in 2004, revealing that there were R&D cost-cutting synergies as a result of the merger. Overall, analyzing the gross margin, SG&A to sales ratio, and R&D to sales ratio graphs, it appears that there were strong synergies at play, and Pfizer's expectations were met, if not surpassed. So now I'll be talking about the takeaways. So lastly, for the takeaways, we have 4 main points. The first was that Pfizer's cost savings expectations were realized. As shown in the SG&A expenditures pre and post-merger chart, we can see the clear cost reduction synergies just as Pfizer had stated. Secondly, the acquisition of Warner Lambert allowed Pfizer to enter the foreign markets where Warner Lambert had profited, namely Ireland and Germany. Third, the acquisition diversified their business lines while also avoiding cannibalism. By having mostly different pharmaceutical segments compared to Warner Lambert, it allowed Pfizer to become the leaders in areas like cardiovascular, endocrine, lipid control drugs, central nervous system, and infectious disease pharmaceutical segments. Lastly, this merger was considered one of the most hostile takeovers in history. Although Pfizer and Warner Lambert were business partners and worked together on Lipitor, one of the largest pharmaceutical brands in history, Pfizer carried through with their hostile bid, blocking American Home Products' merge with Warner Lambert. And then next are our references. And any questions? If not, thank you very much and have a great day.
Dude, it went well.